Recognition and measurement are fundamental concepts within the IASB conceptual framework for financial reporting, providing the basis for determining when financial statement elements should be included and how they should be measured. Recognition determines whether an item should appear in the financial statements, while measurement determines the monetary amount at which that item should be reported. Together, these concepts ensure that financial statements provide relevant and faithfully represented information for economic decision-making. The conceptual framework identifies several measurement bases, including historical cost, current cost, value in use, or fulfillment value, and fair value, each serving different reporting objectives. Recognition in financial statements. Recognition is the process of incorporating an asset, liability, equity item, income, or expense into the statement of financial position or statement of profit or loss. Recognition occurs only when including the item provides information that is both relevant to users' decisions and faithfully represents the underlying economic phenomenon. In addition, the benefits of providing the information must justify the associated costs of obtaining and presenting it. The recognition process therefore requires professional judgment, particularly when uncertainty exists regarding future economic benefits or obligations. Items failing to satisfy recognition criteria may instead require disclosure in the notes rather than formal recognition within the financial statements. Recognition of assets and liabilities. An asset is recognized when the entity controls a present economic resource arising from past events that has the potential to generate future economic benefits. Examples include property, plant and equipment, inventories, receivables, and intangible assets. Recognition depends upon the existence of control and a measurable economic resource rather than merely legal ownership. Conversely, a liability is recognized when an entity has a present obligation resulting from past events requiring the transfer of an economic resource. Obligations may be legal or constructive, provided that settlement is expected to result in an outflow of economic benefits. Typical liabilities include trade payables, borrowings, lease obligations, and provisions. Recognition decisions require careful evaluation of uncertainty. For example, a contingent asset generally fails recognition criteria because future benefits remain uncertain, whereas a provision may be recognized when an obligation exists and a reliable estimate can be made. Recognition of income and expenses. The conceptual framework adopts a balance sheet approach whereby income and expenses arise from changes in recognized assets and liabilities. Income represents increases in assets or decreases in liabilities that result in increases in equity, excluding owner contributions. Revenue recognition under IFRS therefore reflects the transfer of control over goods or services rather than merely the receipt of cash. Expenses represent decreases in assets or increases in liabilities that reduce equity, excluding owner distributions. Expenses are recognized when economic benefits are consumed or obligations arise, ensuring that profit reflects changes in net assets rather than simple cash movements. This approach reinforces accrual accounting by matching economic events to the periods in which they occur rather than when cash is received or paid. Measurement bases. Once recognized, financial statement elements must be assigned a measurement basis. The IASB framework identifies several alternative measurement methods depending upon the nature of the asset or liability and the information needs of users. Historical cost. Historical cost measures assets at the amount of cash or consideration originally paid and liabilities at the amount received in exchange for the obligation. Subsequent depreciation or amortization reflects systematic consumption of economic benefits while preserving the original acquisition cost. Historical cost is widely used because it is objective, verifiable, inexpensive to apply, and relatively free from estimation uncertainty. Transactions are supported by observable market evidence, enhancing reliability and auditability. However, historical cost suffers significant limitations during periods of inflation or rapidly changing market conditions. Asset values may become outdated, depreciation charges understated, and reported profits overstated because replacement costs are ignored. Consequently, historical cost may fail to represent current economic reality, particularly for long-lived assets acquired many years earlier. Current cost. Current cost measures assets at the amount that would currently be paid to acquire an equivalent asset, considering its age and condition, while liabilities are measured at the amount currently required to settle the obligation. Current cost provides information about the resources necessary to maintain operating capacity and better reflects current economic conditions. It is particularly relevant during inflationary periods when replacement costs differ significantly from historical acquisition costs. Nevertheless, Current cost introduces greater subjectivity because replacement values may not always be directly observable, reducing comparability and increasing estimation uncertainty. Value in use and fulfillment value. Value in use measures an asset based on the present value of future cash inflows expected from its continued use and eventual disposal. Similarly, fulfillment value measures liabilities using the present value of future cash outflows expected to settle the obligation. These measures incorporate entity-specific expectations and therefore provide highly relevant information regarding economic value. They are extensively applied in impairment testing under IAS 36 and in measuring long-term obligations. However, discounted cash flow techniques require assumptions regarding future cash flows, discount rates, and risk adjustments, introducing estimation risk and management judgment. Fair value. Fair value represents the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value reflects current market conditions and therefore provides highly relevant information for financial instruments, investment property, biological assets, and revalued non-current assets. It improves comparability between entities by using market-based assumptions rather than entity-specific estimates. Its principal disadvantage is volatility and reliance upon active markets. Where observable market prices do not exist, valuation models become necessary, reducing reliability and increasing subjectivity. Historical cost versus current value accounting. Current value accounting addresses many weaknesses associated with historical cost by reflecting contemporary economic conditions and replacement values. It improves decision usefulness by presenting assets and liabilities closer to their current economic worth and avoiding distorted profits during inflationary periods. However, current value accounting does not completely overcome historical cost limitations. It often depends upon estimates, valuation models, and management assumptions, reducing objectivity and verifiability while increasing complexity and implementation costs. Consequently, modern IFRS adopts a mixed measurement model, combining historical cost with current value techniques where they provide more relevant information, thereby balancing reliability with economic relevance in financial reporting.